Hello, and welcome to Boni's Life, the channel where we dive deep into the stories that shape our world. Today, we're tackling a question that sounds like it's straight out of a financial thriller. Is the United States secretly plotting to dump its colossal $37 trillion national debt into the world of cryptocurrency? It's a claim that has been making headlines, sparking both fear and excitement in financial markets. But is there any truth to it? Or is it just another conspiracy theory designed to stir up uncertainty? In this episode, we're going to separate fact from fiction. We'll analyze the claims, examine the actual policies of the Trump administration, and break down what this could all mean for your investments, the global economy, and the future of money itself. So grab your coffee, get comfortable, and let's get into it. Before we dive into the conspiracy theories, let's establish the magnitude of what we're dealing with. The United States national debt has reached an astronomical $37 trillion as of 2025. To put this in perspective, this represents approximately 140% of the country's GDP. That's more than the entire economic output of the nation for an entire year. This debt burden translates to annual interest payments that are approaching $1.2 trillion per year. That's more than the entire defense budget, more than what the government spends on education, healthcare, and infrastructure combined. Every single day, the US government pays approximately $3.3 billion just in interest on its existing debt. To put that in context, that's enough money to fund the entire NASA budget for nearly 2 months. Every single day, the debt to GDP ratio has been climbing steadily since the 2008 financial crisis, accelerated dramatically during the COVID-19 pandemic, and shows no signs of slowing down. Economic experts from institutions like the Congressional Budget Office project that without significant policy changes, this ratio could reach 200% by 2050. This is entering territory that historically has been associated with sovereign debt crises. So, where did this explosive idea come from? The recent buzz began with a statement from Anton Kobyakov, an advisor to Russian President Vladimir Putin. He claimed the US is planning to rewrite the rules of the crypto and gold markets to erase its massive national debt. Kobyakov's theory is that the US will move a significant portion of its debt into stablecoins and then devalue them, effectively starting with a clean slate. He even drew parallels to the 1930s and 1970s, when the US made major changes to the global financial system to solve its own economic problems. Now, it's important to remember the source of this claim. Russia has a clear geopolitical interest in undermining confidence in the US dollar. The historical precedents Kobyakov references are worth examining. In 1933, President Franklin D. Roosevelt took the United States off the gold standard domestically, devaluing the dollar by 40% and effectively reducing the real burden of government debt. Then, in 1971, President Nixon ended the Bretton Woods system, severing the dollar's link to gold internationally. Both moves were controversial, but ultimately helped the US navigate economic crises. However, the current situation is fundamentally different. In the 1930s and 1970s, the US was dealing with fixed exchange rate systems and gold backing. Today's fiat currency system operates on entirely different principles. The dollar's strength comes not from gold backing, but from the full faith and credit of the US government, the size and stability of the US economy, and the dollar's role as the world's primary reserve currency. Let's examine what leading economists are saying about this situation. Dr. Kenneth Rogoff, former chief economist at the International Monetary Fund and Harvard professor, has warned that the US debt trajectory is unsustainable, but has also noted that the country's unique position as the issuer of the world's reserve currency gives it more flexibility than other nations would have. Meanwhile, Ray Dalio, founder of Bridgewater Associates, has been vocal about his concerns regarding the dollar's long-term prospects. In his recent analysis, he suggests that the US is in the late stages of what he calls the long-term debt cycle, where debt levels become so high that traditional monetary policy becomes ineffective. Dalio has advocated for a more diversified approach to reserves, including both gold and Bitcoin. Nobel Prize-winning economist Paul Krugman, however, takes a more skeptical view of cryptocurrency solutions to debt problems. He argues that the volatility and limited scale of crypto markets make them unsuitable for sovereign debt management. Krugman points out that the entire cryptocurrency market capitalization is still only about 10% of the US national debt. So, with that in mind, let's look at what the Trump administration has actually been doing when it comes to cryptocurrency. And this is where it gets interesting, Because while the idea of dumping the entire national debt into crypto seems far-fetched, the administration has been making some very significant moves in the digital asset space. In March 2025, President Trump signed an executive order to create a strategic Bitcoin reserve. This is a big deal. The US government is officially treating Bitcoin as a reserve asset, much like gold. The reserve is being funded with Bitcoin seized in criminal cases, and the government has stated it will not sell this Bitcoin. They're holding it as a long-term store of value. The strategic Bitcoin reserve currently holds approximately 210,000 Bitcoin, worth roughly $24 billion at current prices. This makes the US government one of the largest Bitcoin holders in the world, ranking alongside major corporations like MicroStrategy and Tesla. The administration has indicated plans to potentially expand this reserve through additional purchases. The White House fact sheet on this even refers to Bitcoin as digital gold, citing its scarcity and security. They've also acknowledged that selling off seized Bitcoin in the past has cost taxpayers billions in potential gains. This is a clear signal that the US government sees real, long-term value in Bitcoin. But holding Bitcoin as a strategic asset is a world away from using it to cancel the national debt. Treasury Secretary Scott Bessent has been particularly vocal about the administration's crypto strategy. In a recent speech at the Economic Club of New York, Bessent outlined what he calls the Digital Dollar Doctrine. This framework envisions the US maintaining its monetary sovereignty while embracing digital assets as complementary tools for economic policy. The administration has also been working closely with Federal Reserve Chair Jerome Powell on what they are calling the Digital Asset Integration Initiative. This program aims to study how cryptocurrencies and central bank digital currencies could be integrated into the existing financial system without undermining the dollar's dominance. Powell, who was initially skeptical of cryptocurrencies, has become more open to their potential role in the financial system. In his latest testimony to Congress, he acknowledged that digital assets represent a significant innovation in financial technology and that the Federal Reserve is committed to understanding their implications for monetary policy and financial stability. The Genius Act, passed in July 2025, provides the regulatory framework for this new approach. The legislation establishes clear guidelines for cryptocurrency taxation, creates a regulatory sandbox for digital asset innovation, and most importantly, provides legal clarity for government holdings of digital assets. The act was supported by a bipartisan coalition, with Senator Cynthia Lomis and Representative Patrick McHenry leading the charge. Under the Genius Act, the Treasury Department has been authorized to hold up to $100 billion worth of digital assets as part of the strategic reserve. This represents a significant expansion from the current Bitcoin-only approach to include other major cryptocurrencies like Ethereum and potentially even stablecoins backed by US Treasury securities. The concept of using cryptocurrency to manage sovereign debt isn't entirely without precedent. El Salvador, under President Nayib Bukele, has been experimenting with Bitcoin as legal tender and has used Bitcoin bonds to finance government operations. While El Salvador's economy is tiny compared to the United States, their experience provides valuable insights. El Salvador's Bitcoin experiment has had mixed results. On the positive side, the country has attracted significant foreign investment and has positioned itself as a leader in cryptocurrency adoption. However, the volatility of Bitcoin has also created challenges for government budgeting and has drawn criticism from international financial institutions. The key difference is scale. El Salvador's entire GDP is about $28 billion, making their Bitcoin holdings a significant portion of their economy. For the United States, even a $100 billion digital asset reserve would represent less than 0.5% of GDP and less than 0.3% of the national debt. So what would actually happen if the US decided to go down this road? We've crunched the numbers and created 4 potential scenarios, ranging from the most likely to the most extreme. Scenario 1, the strategic reserve enhancement. This is the most likely outcome, with a 65% probability. The US continues with its current policy, but gradually expands the strategic Bitcoin reserve to reach the $100 billion target authorized under the Genius Act. This would involve purchasing approximately 870,000 additional Bitcoin at current prices, representing about 4% of the total Bitcoin supply. The market impact would be significant but manageable. Bitcoin would likely see sustained upward pressure, potentially reaching $150,000 to $200,000 per coin over the next 2 to 3 years. This represents a 30% to 75% increase from current levels. For other cryptocurrencies, the effect would be mixed. Ethereum and other major altcoins would likely benefit from the overall positive sentiment toward digital assets, potentially seeing 20% to 40% gains. However, some speculative projects might actually suffer as institutional money flows toward more established cryptocurrencies. The dollar would remain strong in this scenario, as the Bitcoin purchases would be seen as a complement to, rather than a replacement for, traditional reserves. Gold might see some modest pressure, declining 5% to 10%, as some investors view Bitcoin as a more modern store of value. Scenario 2. Partial debt tokenization. In this scenario, with a 25% probability, the US decides to convert about 5% to 10% of its debt into digital tokens, likely stablecoins backed by a basket of assets including Bitcoin, Ethereum, and traditional treasury securities. This would represent $1.8 to $3.7 trillion worth of tokenized debt. The mechanism would work through the creation of what Treasury Secretary Bessent has termed digital treasury securities, or DTS. These would be blockchain-based versions of traditional treasury bonds, offering the same interest rates and government backing, but with the added benefits of 24/7 trading, instant settlement, and programmable features. The advantages are compelling. Digital treasury securities could reduce the government's borrowing costs by eliminating intermediaries and reducing settlement times from days to minutes. They could also attract a new class of international investors who prefer digital assets. Some estimates suggest this could reduce the government's annual interest payments by $50 to $100 billion. The market impact would be substantial. Bitcoin could surge 40% to 60% as demand for the underlying asset backing the DTS increases. The total cryptocurrency market capitalization could double or triple, reaching $8 to $12 trillion. The dollar would face some pressure in this scenario, potentially declining 10% to 15% against major currencies as markets adjust to the new reality. However, the dollar's fundamental strengths would likely prevent a collapse. Scenario 3. Major crypto integration. With an 8% probability, the US government could decide to convert 20% to 30% of its debt into a comprehensive digital asset strategy. This would involve $7.4 to $11.1 trillion worth of debt restructuring, representing the largest financial transformation in human history. This scenario would likely emerge from a severe fiscal crisis, perhaps triggered by a major economic recession or a loss of confidence in traditional government debt. The scale of change would be unprecedented, requiring new legislation, international agreements, and technological infrastructure. The market impacts would be extraordinary. Bitcoin could reach $300,000 to $500,000 per coin, representing 160% to 335% increase from current levels. The total cryptocurrency market could reach $20 to $30 trillion, making it larger than the current US stock market. However, this scenario would also create enormous volatility and uncertainty. The dollar could decline 25% to 40% against major currencies, potentially ending its role as the dominant global reserve currency. Scenario 4. The full crypto reset. This is the ultimate transformation scenario for the global financial system with a very low 2% probability. In this theoretical situation, the US attempts a complete restructuring of its debt using cryptocurrency, essentially creating a new monetary system based on digital assets. The market impacts would be beyond anything we've seen in financial history. Bitcoin could reach $1 million per coin or higher, representing a 770% increase from current levels. The total cryptocurrency market could reach $50 to $100 trillion, making it the dominant global asset class. However, the disruption would be equally extreme. The dollar could lose 60% to 80% of its value against other major currencies, potentially triggering a global financial crisis. So, what does all this mean for you, the investor? Let's break down the potential impact on different assets. For cryptocurrency investors, the potential upside is enormous, especially in the more extreme scenarios. However, the path would not be smooth. Even in the most optimistic scenarios, we would likely see periods of extreme volatility, with 50% corrections being common even within overall upward trends. The key for crypto investors would be diversification and risk management. While Bitcoin and Ethereum would likely be the primary beneficiaries of government adoption, Smaller cryptocurrencies could see even larger percentage gains. However, they would also face higher risks of complete loss if they fail to maintain relevance. For gold investors, the future is more uncertain. In moderate scenarios, gold could still serve as a hedge against inflation and currency debasement. However, in scenarios involving major cryptocurrency adoption, gold's traditional role could be significantly diminished. Gold has several advantages that are difficult to replicate digitally. It's physical, it has thousands of years of history, and it doesn't depend on technology infrastructure. However, Bitcoin and other cryptocurrencies offer advantages that gold cannot match. They're easily divisible, instantly transferable, and can be programmed with smart contract functionality. For those holding dollars, the risk varies significantly by scenario. In the most likely scenarios, the dollar would remain strong, supported by the underlying strength of the US economy and the network effects of dollar usage in international trade. However, in more extreme scenarios, dollar holders could face significant losses. The key would be diversification across currencies and asset classes. For stock market investors, the impact would be complex and sector dependent. Technology companies, particularly those involved in cryptocurrency and blockchain technology, would likely be major beneficiaries. Companies like Nvidia, which produces chips used in cryptocurrency mining, could see substantial gains. Financial services companies would face mixed impacts. Traditional banks might struggle if cryptocurrency adoption reduces demand for traditional banking services. However, banks that successfully adapt to the new environment could benefit from new revenue streams related to digital asset custody and trading. Let's also examine the international perspective. How would other major economies respond to significant US cryptocurrency adoption? The European Union has been developing its own digital euro project led by the European Central Bank. EU officials have expressed both interest in and concern about US cryptocurrency initiatives. They recognize the potential benefits of digital assets for reducing transaction costs and increasing financial inclusion, but worry about the implications for European monetary sovereignty. European Central Bank President Christine Lagarde has been particularly vocal about the need for international coordination on digital asset policies. In a recent speech in Frankfurt, she warned that uncoordinated national approaches to cryptocurrency could lead to digital fragmentation of the global financial system. China presents a more complex case. The Chinese government has banned private cryptocurrencies like Bitcoin, but has been aggressively developing its own central bank digital currency, the digital yuan. Chinese officials view US cryptocurrency adoption as both an opportunity and a threat. On one hand, increased global acceptance of digital currencies could benefit China's digital yuan project. On the other hand, US adoption of Bitcoin and other decentralized cryptocurrencies could undermine China's goal of creating a state-controlled digital currency system. Japan has been more open to cryptocurrency adoption, with the yen being one of the major fiat currencies used to trade Bitcoin. The Bank of Japan has been studying digital currency options and has expressed interest in international cooperation on digital asset standards. Russia's position is particularly interesting given that the cryptocurrency debt claims originated from Russian officials. While Russia has been critical of US financial policies, it has also been developing its own digital ruble project and has shown interest in using cryptocurrencies to circumvent international sanctions. The implications for developing countries could be particularly significant. Many emerging market economies already face challenges with currency stability and capital flight. Major US cryptocurrency adoption could exacerbate these problems by providing an easily accessible alternative to local currencies. However, some developing countries might also benefit from increased cryptocurrency adoption. Countries with large remittance flows, such as Mexico, the Philippines, and Nigeria, could see reduced transaction costs and increased financial inclusion as cryptocurrency becomes more mainstream. The International Monetary Fund has been studying the implications of widespread cryptocurrency adoption for global financial stability. IMF Managing Director Kristalina Georgieva has warned that rapid changes in the international monetary system could create new risks for emerging market economies. So, after all this comprehensive analysis, what's the bottom line? Is the US planning to dump its debt into crypto? The evidence suggests that the sensational claims from Russia are more propaganda than reality. There is no credible plan to simply wipe out the national debt with a magical crypto wand. However, what we are seeing is a very deliberate and strategic shift by the US government. The creation of the strategic Bitcoin reserve is a clear sign that the Trump administration sees cryptocurrency, particularly Bitcoin, as a serious asset for the future. They are not trying to destroy the dollar. They are trying to fortify it for a new financial era. The real story here is not a conspiracy but a calculated adaptation. The US is positioning itself to be a leader in the digital asset space, and that will have major implications for the future of finance. The scale and pace of change will depend on various factors, including technological developments, regulatory frameworks, and international cooperation. For investors, the key is to stay informed and maintain a diversified approach. The cryptocurrency space offers enormous opportunities, but also significant risks. Traditional assets like stocks, bonds, and real estate will likely remain important components of a balanced portfolio, even in a more digital financial world. The most important thing to remember is that we are still in the early stages of this transformation. The decisions made by policymakers, technologists, and investors over the next few years will shape the financial system for decades to come. It's a story we'll be following closely here on Boni's Life, providing you with the in-depth analysis and insights you need to navigate this changing landscape. Make sure you subscribe and hit that notification bell so you don't miss our next deep dive. We'll be covering the latest developments in cryptocurrency policy, market analysis, and investment strategies. Thanks for watching, and as always, stay informed, stay diversified, and stay ahead of the curve.